Have you ever taken a loan thinking that the interest was low, but you ended up paying way more than you anticipated? Well, here is the secret. Not every interest is created the same. Welcome to a word from the coach. Today we are looking at two different words in the world of interest rates that could change how much you end up paying on the loans that you apply. Now, interest rates can be described as either being on flat rate basis or being on reducing balance basis. And today we are looking at these two terms that could eventually change how much you get to pay on a loan that you would take. By the end of this video, you should know which one would exactly work for you, which one will save you money, and which one is exactly the one you need for your next loan. So stay tuned. This might be the most important lesson that you ever get to learn before your next loan. If this is your first time here, please subscribe to this YouTube channel. And if you like this conversation, please drop us a like, give us a comment. And if you have any question you'd like to ask, feel free to do so in the comment section or inbox me in my various inboxes. And I'll be glad to make another word from the coach video in response to the same. Now, as I describe the differences between flat rate basis of interest and reducing balance basis of interest, I would want to look at 4 areas of differences that will help you be able to see the differences. And I want to make this as simple as possible so that every one of us can be able to understand. So I'll not be complicating things. I will not be loading this video with a lot of jargon. I want to explain it in a way that all of us can be able to understand. So I'll be looking at application for us to see how different are they applied. Number 2, I'll be looking at what I'm calling repayment distribution. Number 3, I'll be looking at magnitude. And then lastly, I'll be looking at early settlement. Then you will be able to see how different they are. So in terms of application, and even as I get to define them, flat rate interest is where interest is applied on the original principal amount throughout the loan period, regardless of how much has been repaid after every period. And for us to be able to understand this, I want us to use an example. Assume you have taken a loan of 120,000 shillings to be repaid in a duration of 3 years, assuming we have one repayment per year of 40,000. And this is just for purposes of simplifying this for us to be able to understand. And assuming that the annual rate is 15%. So I want us to use this example to see how does it play out in a flat rate situation and how does it play out in a reducing balance situation as we see how they differ in terms of application. Now, beginning with the flat rate, in the example that I've just given, a principal of 120,000 at the interest rate of 15% per annum, and the duration is 3 years. A flat rate interest uses the simple interest formula that states that interest is equal to principal times rate times time. In other words, in our example, the principal is 120 times rate, which is 15%, times time, which is 3 years. That gives us the interest payable as 54,000 shillings at the end of the 3 years. What a flat rate regime assumes is that you will pay the same interest amount every year across the duration without caring that at the end of year 1, for example, the loan balance has come down. So in this particular case, a flat rate interest regime assumes that every year you will still pay interest of 18,000, 18,000, 18,000. That would be principal 200,000 times rate 15% times 1 for year 1, which is 18,000. Second year, it will be the same, and the principal remains as it was in the beginning. I want you to mark that. So in this particular case, then we end up paying interest of 54,000 shillings. Interest is applied on the original principal amount, in this case 120,000, across the duration of the loan, 3 years. It does not care that you have repaid and some balance is remaining. That is how a flat rate interest is applied. Now, when you move to the reducing balance basis, interest is applied only on the outstanding balance after every repayment season. In other words, it is only calculated on the amount outstanding. If we use this example, let me bring this other screen, then assuming that the same parameters we have used apply, then year 1, we will use principal times rate times time, the principal being the original 120,000, which will give us 18,000 shillings for year 1. So in both cases, for year 1, 18,000 shillings. Now for year 2, the interest will be on the outstanding principal. Remember, we are assuming that the principal reduces by 40,000 every year. So for year 2, the interest will be on the principal remaining, which is 120 minus 40,000, in this case 80,000, times rate times 1 for that second year. That will give us 12,000. You begin to see the difference. In the flat rate regime, the interest was the same. So the second year still gave us 18,000, but reducing balance gives us 12,000. When we move to year 3, we still take the same calculation, but the principal amount is what is remaining after the 40,000 is repaid after the second year. In this case, we are left with a principal of 40,000. That is 80,000, which was the principal in year 2, minus 40,000 that was paid at the end of year 2. And that gives us a principal of 40,000 times 15% times 1 year, the last year. That gives us interest of 6,000 shillings. And therefore, in total, at the end of the period, someone who took a loan that is being calculated using the reducing balance basis will end up paying 36,000 shillings. That is how differently these two regimes are applied. So that's the first way of differentiating them using application, how they are applied. Number 2, we can differentiate them using what I call repayment distribution. Those of you that have taken loans, you realize that every loan you take has got something they call repayment amount. That is the amount you are deducted every cycle. If you are paying monthly, that will be your monthly repayment amount. Assuming that you've taken a loan whose monthly repayment amount is, say, 20,000 shillings per month. Out of this monthly repayment amount, we usually get to split it. A portion takes care of interest and another portion takes care of reducing the principal. So if your repayment amount is 20,000 shillings, for example, per month or whatever period, in a flat rate regime, if 5,000 shillings goes to interest, that is how it will remain across the period of the loan. So if in your 20,000 deduction, 5,000 goes to interest, 15,000 goes to reduce principal. That is how it will be for the first month, for the second month, and all the months of the duration of your loan. If you borrowed under the reducing balance regime, there will be a difference. Assume both of us are repaying at 20,000 per month. The amount would still be split into a portion going to reduce interest, to pay interest, and a portion going to reduce principal. But there is a difference in how it plays across the loan period. In a reducing balance regime, the interest amount will be reducing every repayment period, while the amount that goes to principal will be increasing. So in our example of 20,000, if the first month 5,000 shillings went to interest and 15,000 shillings went to reduce principal, in the second month you will find 4,000 and something going to interest and 15,000 and something going to reduce principal. In the third month, you will find a lower figure going to interest and a bigger figure going to principal. In essence, therefore, your loan begins to move at an increasing rate in terms of reducing the principal balance. The principal balance reduces at an increasing rate as you continue to repay your loan. At the same time, the amount that goes to interest also reduces as you repay your loan. That is something notable. In fact, let me put for you a table here that would just show you the difference. So in this example, I have assumed a loan of 100,000 shillings at 18% per month. Assume it is repaid for 12 months, just for our purposes of understanding. And I want your attention to go to the columns colored green and blue. When you take the loan of 100,000, so the starting balance is 100,000, this person, we are assuming that every month they are deducted 9,168. Out of that amount, a portion goes to reduce principal, a portion goes to pay interest. Then we have the closing balance. So you will see in month 1, 7668 went to reduce principal, 1,500 went to pay interest. Then if you look at the second month, you will realize that 7783, which is bigger than the first amount, goes to principal, and 1384, which is lower than the first amount, goes to interest. Now that is the situation across the period. So it's like they're moving in the opposite direction. The amount that goes into principal is climbing, while the amount that goes into interest is decreasing. That is a difference that needs to be noted between those two regimes. Number 3, we look at the cost magnitude. So which one is expensive? Where do you get to pay more? And the answer, as you saw in the example of application, it is clear that when you borrow under a flat rate regime, then you will end up paying more interest than when you borrow under a reducing balance regime. Unfortunately, many borrowers only look at the number they've been given called interest. And some lenders now know that that is our weakness. That is why they will tell you interest is at 10%. And then there's another lender who is telling you interest is at 15%, reducing balance. Our eyes are literally comparing 15 and 10. And so all of us go to borrow from where they are saying 10%, but we are not caring to ask whether it is 10% flat or 10% reducing. Now, if it is 10% flat, then you might end up paying more than the person who is paying at another number that looks bigger, but on reducing balance. So it's important that you get to clarify just before you get to commit. Number 4 way of differentiating is through early settlement. This is where you choose to clear the loan earlier, before the end of the full term. There will be some differences in these two regimes. If you borrowed from a flat rate regime, many times you will still end up paying the total interest you needed to pay at the end of a particular period, even if you cleared your loan early. Even though these days I have seen a few lenders sometimes advancing some discounts and saying, if you cleared early, then we might discount some 5% out of the total that you ought to pay. But the modus operandi, the way of operation of a flat rate regime, is that once we have calculated the interest, we know that, for example, in our first example, you're supposed to pay 54,000 at the end of the period. That is what you will pay. If you choose to clear your loan earlier, that was your choice. But the original arrangement is that by the end of the period, this is what you ought to pay us. So you will pay us. If you had borrowed from a reducing balance regime, then when you choose to settle early, automatically then you save the interest you would have paid in the remaining period. For example, you had borrowed money that was to be repaid in 5 years. After 3 years, you get some lump sum amount and you inject in your balance and you clear it. Then the interest that you would have paid for the remaining 2 years gets to be a gain for you, because it only charges you interest on the outstanding balance. So on the day of your settlement, they will calculate interest on the principal balance as at that time. And that will form the amount that you will pay to clear the remaining balance. So it's important that you also notice those two differences, so that when you are taking up the loan, you also get to ask them, what happens in the event that I decide to clear early? If they tell you that when you clear early, you will still pay us everything, then you might want to be careful, because you might be in a regime that is not favoring you. So are there any advantages attached to each of these regimes? Yes, each of them works somewhere and does not work somewhere. A flat rate regime, for example, is very easy to calculate. From a lender's perspective, it is very easy to determine and to apply. It is straightforward. Number two, from a buyer's perspective, a borrower's perspective, it is very easy to understand. It is not complicated. Every one of us can just see principal times rate times time. So it is straightforward. It doesn't seem to have anything hidden. By the way, none of the regimes has anything hidden, but a flat rate regime is very simple, very straightforward. So for those people who don't want to disturb their heads with thinking about how did they arrive at this, then a flat rate regime would work for them. Easy to understand and also easy to apply from a lender's perspective. The only disadvantage that is big is that it costs you more eventually. Now, a reducing balance regime, in terms of advantages, is number one, that it will cost you less. Like we saw in our example during application, the interest you get to pay at the end of the period is less compared to the interest you pay in a flat regime. Number two, when you get to settle early, then you save automatically the interest for the period that was remaining. And that is also a disadvantage for the flat regime, because when you settle early, then it is not automatic that you will save the interest for the remaining period. But in terms of disadvantages, this reducing balance regime is not easy to calculate, even from a lender's perspective. Then it forces us to use what we call an amortization formula. It is not hard to explain, of course, not for everyone, but you can see from the figures I have displayed here, you can try to understand the things I have explained, but it is not as simple to apply as the flat rate. So it might seem to look a bit complicated. Number two, it seems a bit complicated to the borrower in terms of understanding how it is calculated and how it is applied in your situation, because this other one just takes principal times rate times time. But this one, once we get into the complications of calculations where your loan period is long and all those details, and we apply the amortization formula, when you get to see the figures of the amortization schedules, you might think it's a bit bombarding, but the end result always speak for themselves, that it charges you less than the other regime. That would be the only disadvantage associated with it. But you as a borrower, I doubt that you are borrowing just because you are able to understand how calculation is made, even though I know that some of us would want to borrow from a regime we can easily understand. So you do your weigh your options and see whether you are following understandability or following bottom line. Okay, but that then gives us the difference between those two. So now you know a flat rate might look simple and cheap at first, but eventually gets to cost you more. So before signing that loan agreement, please get to ask, get to inquire how their interest is calculated, get to know which regime they are operating from, whether they are using the flat rate regime or they are using the reducing balance regime, so that you are clear from the onset, so that later on you do not come complaining that you thought they were going to charge you less, but they have ultimately charged you more. So if this video has helped you to understand loans more, and especially where interest is concerned, please hit the like button. Drop us a comment, get to share this with someone else, because your friends might also just be losing money because they are not asking or understanding the difference between those two regimes. Remember, it's not just about getting a loan, but it's about borrowing wisely and paying smart. So don't be a blind borrower. Be a deliberate borrower. Go into debt with your eyes open, because debt is not free money. Debt comes at a cost. You can do better. See you in the next.